as a founder, prep for the acquisition, right? Chances are whoever you're negotiating with on the other side does this all the time and you don't.
Such a good point.
You need to think about all the rules of negotiation matter. You know, they're not, the folks on the other side are not your friends. They might act like it sometimes. They're not. Don't let your ego get the best of you. They might try to fluff you up and things like that at certain times. Don't let that happen. You have to negotiate like a real negotiator and lean on your team to help you do that.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to the Run the Numbers podcast. Today's guest is David Siegel, managing director at Grellas Shah, a Silicon Valley law firm known for guiding some of the biggest names in tech through raises, exits, and everything in between. David's been in the room for the kinds of deals that make the headlines and also the ones that quietly shape the valley. We're going to talk about what happens when a CFO or a CEO decides it's time to sell, from figuring out whether you're in 30 million write-off territory, $1 billion party territory, or that awkward 150 to 350 million messy middle that nobody quite knows how to navigate. We'll dig into banker versus relationship routes, why David says he's not anti-banker, but anti-bad banker. Me too. And the LOI traps that can lock you into bad terms before you even realize it. We'll also get into the tug-of-war between banker advice and lawyer advice, the conflicts CFOs have to mediate, and the ways to de-risk your company before a buyer even shows up. You always got to stay exit ready. And of course, we'll talk about the human side of selling, from the emotional whiplash founders face to the deals David's had to talk people out of, even when the paper looked great. All this and much, much more after a short word from our sponsors. Listen, being a CFO, it's not always that glamorous. Sometimes I find myself watering the plants and taking out the garbage in the office. And, you know, the best CFOs I know they're true business leaders. They know how to drive growth in heroic fashion. Unfortunately, the status quo of finance makes that really hard because day to day, we're mostly up to our eyeballs in spreadsheets and receipts. Thankfully, there's a financial provider who has built a solution to match your ambition, Brex. Brex designed a modern corporate card and spend platform that controls spend proactively and automates tedious expense and accounting tasks. Brex frees up CFOs to focus on high-impact projects that drive growth. You know, the shit that's actually worth your CFO time. So how does Brex work? You can embed your expense policy inside the corporate card to prevent out-of-policy spend before it happens. Receipts and memos are auto-generated, so you always have what you need to close the books fast. Managers get freed up from reviewing, every possible expense under the sun because in-policy expenses are auto-approved, and AI will flag any exceptions. And all the while, your expense detail is syncing with your ERP because Brex integrates with almost all of them. I love that, from QuickBooks to NetSuite. It's your time to shine as the strategic growth driver you are, and Brex can make it easy. More than 30,000 companies like DoorDash, Coinbase, and SeatGeek use Brex to make every dollar and every minute count. Join them at brex.com/metrics. That's brex.com/metrics. So if you listen to this podcast, you'll know that I am incredibly passionate about the FP&A space because that's the route I went to get to CFO. And I want to tell you about a tool that has exploded over the past few years. It's called Aleph. And I remember getting outbounded by them about 2.5 years ago, and I actually took the bait because they claimed to be able to do a demo with my live data, with me right there on the call. And so I had to see it to believe it. And it was the founder running demos back then. Shout out Albert, hope you're listening. And he connected my NetSuite and built my P&L using their Excel add-in in like 15 minutes. And I was really impressed. Since then, Aleph has gone on to raise money from some of the top VCs out there, and they've built an impressive roster of customers. Many of their customers have been on the podcast, like the CFO at Turo, 8 Sleep, and Zapier. They're all really big champions and supporters of Aleph like me. But it's not just an Excel add-in. Aleph also allows finance teams to work with their live cross-system data using Google Sheets and their web app. And that's cool because it gives teams the option to support a wide range of needs and workflows like budgeting, forecasting, and variance analysis. And speaking of variance analysis, they're doing some really cool things with AI-powered variance analysis. It basically allows you to figure out what's going on and why, and it takes the time that you'd usually spend from hours to minutes. It's really cool. So I highly recommend checking them out. and taking them up on that demo or trial, just like I did back in the day. And you can learn more and get started at getaleph.com/run. That is getaleph.com, aleph.com/run. Tell them CJ sent you. All right, I got to get up on my soapbox for a sec here. Everybody's talking about AI powered this and automated that. But here's the thing about revenue recognition. It's not just about moving data around. It's about getting it right, full stop. So RightRev is laser focused on one thing, RevRec that auditors actually trust. See, there's a difference between automating revenue processes and automating revenue recognition correctly. RightRev was actually built by the godfather of RevRec, who understands ASC 606 compliance, audit controls, data validation, and the flexibility needed for complex B2B contracts. We're not trying to be your billing system or your ERP. We're the revenue recognition engine that sits between your contracts and your financials, making sure every dollar is recognized correctly, on time, every time. Companies like Snowflake and Logic Monitor don't just need fast revenue reporting, they need revenue reporting that's audit ready from day one. And that's honestly where RightRev shines. And what I love about RightRev is they're not out there trying to be everything to everyone and just slap some, AI slop on top of it. While everyone is building these massive platforms that do everything in a kind of mediocre fashion, RightRev does one thing exceptionally well. They make sure your revenue recognition is bulletproof. Ready to stop gambling with your RevRec? Visit RightRev.com to see how we make complex revenue simple. That's RightRev.com, where revenue recognition actually works. David, welcome to the podcast.
Thank you for having me.
Word on the street is you've helped sell a company or two.
I certainly at least that many, yes.
If you had to guess, we're going to do longest and shortest here. What's the longest it's taken to get a deal done from when you were engaged to the end in your career?
Engaged for an M&A process, probably a year would be the longest.
Oh, that would kill me if I was on the operator on the other end, just like with it in flux for a year. That would give me some serious heartburn at night.
It's not great for a company to be in full-on sale mode for that long. It's hard to actually operate a company and sell a company at the same time.
Well, my mind went to I bet the operating metrics weren't looking necessarily better if they're focusing that much time and effort on selling it.
No, because you can't really grow and sell. It doesn't work. It's worse than it even sounds, probably, because there are whole mindset shifts when you're in sale mode. And those mindset shifts are not towards growth. They're towards exit.
Because you are legally constrained from doing some things, right? Like you kind of get put into a box where you're not supposed to do things that quote unquote look outside the ordinary, which sometimes can even be hiring key employees. But to your point too, there's the psychological element, 1 foot in, 1 foot out.
Well, yeah. I mean, so in a typical, if you're doing a term sheet or a letter of intent for a sale, there will be legal constraints on things that can matter a lot. There might be, you have to operate in the ordinary course of business, which does put you in a box. There might be, or often is, limitations on things like raising money during a sale process, which, depending on the type of industry you're in and kind of your model for operating, raising money might be a key part of how you continue to operate and grow. So if you go through months and months and months without that being an option for you, that can seriously hamper what you're able to do.
What's the shortest you've ever seen a deal get done in?
2 weeks, probably.
Oh, wow. That is blazing fast.
But, that's fire sale, not big numbers kind of deal.
I actually was oh, wow, it must have been just such a good deal. And the other side really wanted to do it that they got it done. But you're saying it actually was a fire sale. Actually,
interestingly enough, buyer side deals we do really, really, really quickly for the reason that you state. It's
we need this, we want it, we don't really care.
Desperately want this thing, and we have to do it really, really quickly. That doesn't tend to end up with very buyer friendly terms, but actually in the end, I find that the buyers are typically happy with those deals.
Really?
Yeah. When I say not buyer friendly terms, I mean, obviously they're going to be happy enough up front with a price. So we got that kind of out of the way.
Yeah.
from a diligence standpoint, there's only so much we can do. These, again, don't tend to be very big deals, but usually you can do enough of a smell test in, say, 3 weeks to know if there are any big blaring problems. And the reality is, more often than not, there aren't. I mean, the risk, I'm a lawyer. I perceive risk everywhere, but, oftentimes there's a low probability of the risky thing actually happening. It's just that if it does happen, that could be really, really, really bad.
And what would, in today's environment, what do you think the median time to close a deal is? How fast are deals getting done? And we can talk about like how many are getting done in a sec, but like what's a typical process take?
From LOI to close, 120 days.
Yeah, it sounds right. Okay.
But, LOI to signing, maybe 90.
Yeah. Yeah, but to close.
And getting to signing is huge, right?
Yeah, that's the bulk of the lift.
That's the bulk of the lift, yeah.
That's great context. Well, I guess teeing you up for some more convo on this, if you're a CFO or a CEO who's listening to this and you think it is the right time to sell your company, or at least explore the option, how do you even start that process?
How exactly you start the process depends on kind of the context under which you're selling. Mm-hmm. And also the answer is very different for a CEO and CFO, or depending on the type of CEO and CFO. So if you're the majority owner, CEO, founder type, you're going to control a lot. So what you want matters a huge amount, while the CFO, it might not matter nearly as much. You might be being tasked to do this.
Yeah, totally.
Putting that aside, you want to start, why do you want to sell? Why does this company want to sell? And is it because people are tired and just want an out? Is it a particularly good time for your company? Like there's something to take advantage of? Are you kind of coming to the end of, the rope in terms of what you can do with this company? Like it's not if you need to be on some sort of growth trajectory and you can no longer really sustain that without being part of a bigger organization. It really matters what the reason is, because it's going to impact how you go out and try to sell your company. So figure out your reason, then look internally and who are the constituencies that have to be made happy, might not be the word to use, happy enough, who, from a hard power kind of standpoint, what approvals do you need? Because if you need some certain investor approvals or debt holder approvals, you need to start talking to those people and find out something about their appetite for a sale, what a sale would look like that they'd approve, because what's the point otherwise, right?
Yeah.
And that's when you can start to take a look at what you would need internally, particularly from a CFO standpoint, what you would need internally, what kind of shape you need to be in to start actually going into a sale process.
That totally checks out. And maybe you could speak to just how you have to be realistic about things. Like, what are we actually worth and why now?
Well, that's one of those like CFO and CEO diverging things. CEOs have some latitude to be visionaries that CFOs can't be in the same way. They're being tasked with being more realistic. It's interesting because, most of our clients at my firm are tech startups, and they think about valuations in ways that are very unique to that space. So, people talk about pre and post money valuations for funding rounds, and these, $100, $200, $500 million valuations get thrown out, and people think that those are what the company is worth. And it's really not. Outside of the world of pricing the price per share for a preferred stock VC financing, nobody cares about those numbers, really. And so when you start getting into the world of being acquired, acquirers don't care about those pie in the sky numbers. They care about something concrete. And that concrete thing might very much differ. People talk about multiples, for example, of various sorts, to try to price out the value of a company for a sale. And those multiples don't match in VC financings versus acquisition context. But that's not the only way. For an acquirer, there might be strategic reasons to acquire a company that has nothing to do with, the revenue that the company takes in. But you don't go to a VC with financial projections from a CFO to come up with the valuation in nearly the same way that you do when you're going to an acquirer who's going to buy your company.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Most finance leaders still see travel as a cost center, something to manage, reduce, or delay until the numbers look better. But the Navan Business Travel Index, validated by NASDAQ, empowered by millions of corporate transactions captured through Navan's platform on how organizations are meeting and investing in face-to-face connections to fuel growth, tells a different story. Companies that are growing are moving. Business travel activity is up double digits year over year. International hotel spend is rising faster than domestic. Rideshare use is surging as teams compress more high-value meetings into fewer days. This isn't about perks. It's about pipeline, deal velocity, and customer retention. The CFOs winning right now aren't slashing travel, they're optimizing it. They know exactly where every dollar is going and the ROI it's delivering. The Navan BTI helps you see how your program stacks up against the market each quarter and where you might be leaving revenue on the table. Get the data. Spot the gaps. Turn your travel spend into a competitive edge. Download the latest Navan Business Travel Index today at navan.com/BTI. That's navan.com/BTI. And lead with the numbers that actually drive growth. Morgan Stanley recently said NetSuite is under the threat of disruption. That's right, NetSuite, the you never get fired for buying it software. So what's the threat? The answer, Rillet. Rillet is the AI native ERP modern finance teams are switching to because it's faster, simpler, and 100% built for how teams operate today. It doesn't take 12 months to implement, it doesn't feel like filing taxes to use, and your accounting team will actually love it. PostScript closes the books in only 3 days. Windsurf, bet you heard of them. They run finance with just 2 people. And Rillet is backed by Sequoia Capital. Yes, that's Sequoia. Unicorns like PostScript and Windsurf and hundreds of other companies have made the switch, and they're closing books in record time. If I were running a finance team today, I wouldn't default to legacy. I'd look at what's coming next, and Rillet is here. You don't want to be that guy at cocktail parties complaining about how bad his ERP is. Wait, am I the only guy who talks about ERPs around a keg? See how fast your team can move. Book a demo at rillet.com/metrics. That's RILLET.com/metrics. RILLET.com/metrics. As a CFO, you're expected to bring clarity to everything, including how your company manages ownership. The tools you use should make that easier, not harder. But when they come with hidden fees, data you can't always trust, and support you can't rely on, you end up with more frustration than clarity. That's where Pulley comes in. Pulley is a cap table management platform built for finance leaders who need accurate, decision-ready data from a system that works for your business, not against it. With Pulley, you get intuitive workflows, audit-ready reporting, and support you can count on, all backed by predictable pricing you can plan around, so you can stay compliant and make smarter decisions about your company's future. Manage everything from fundraise modeling to ASC 718 reporting to custom liquidity programs, all on one trusted platform. Hundreds of high-growth companies like Linear, Fathom, and Runway trust Pulley to help turn ownership into a strategic advantage. And joining them is now easier than ever. You can switch to Pulley in as little as 5 days. And for a limited time, they're offering 25% off your first year. To claim your exclusive offer, visit pulley.com/mostlymetrics. That is pulley.com/mostlymetrics. Pulley.com/mostlymetrics. And I'm really glad you said that, because that's where the rubber hits the road on expectations versus reality, especially when you're selling all of a company, 100% of a company, and then someone has to take on the execution risk of then running it. That's very different than someone giving you quote unquote cheap capital and placing a valuation on you for 10 or 20% of your company. Like, those are fundamentally two different things, but people conflate the two.
Right. And when a VC is putting money into a company, what they're typically doing is crossing their fingers for some sort of huge home run and willing to and expecting to take the risk of losing all that money. But acquirers are not doing that. That is not in remotely the way an acquirer is going to look at your company.
Yes, that is so well said, because you may be one of 20 companies in a VC's portfolio that like the way that they've mathematically constructed the portfolio, some won't work. It's just part of the game. But if you're being acquired and you're buying 100% of it and there's a strategic reason for it, it is much less of a dice roll.
Exactly.
David, you've said that 30 million may be considered like a write-off in some of these transactions. 1 billion is a party, but like the 150 million to 350 million range, I want to hone in on that. What makes that the awkward middle?
It does depend on the stage of the company, but it's particularly the awkward middle in a kind of midi market VC backed company.
And a lot of the listeners are from that background, so they'll be familiar with it.
So you've done a Series B or a Series C, and you've raised money at various different valuations. When you're selling at 30 million, chances are folks aren't. Maybe people are getting their money back, probably not getting their money back. But at that point, nobody really cares.
It's below the line.
It's below the line. It doesn't really matter. And obviously in the normative case, anything in the, 1 billion or more range, everyone's making money. The problem with the middle range is that some folks will make money. Some folks won't make money. The founders are probably making a decently nice amount of money. They're excited about this and trying to sell a deal to investors who are not making out nearly the same way. So, the enthusiasm will differ. What you're asking investors to do, I mean, investors are going to be asked to sign on to some aspects of a deal that are not necessarily things that they want to sign on to. And they're essentially doing it as a favor. And so it can be awkward.
What I've noticed in that range is it is crazy, life-changing, potentially generational money for the founders within that. Call it, let's say you're around 250. Like that's a game changer. Like you don't have to work. You don't have to work again if you did the cap table right. But for many of the investors, especially the last round, they probably underwrote a much larger number. And even if they get like a 1.5x return, that's like nothing to write home about.
Right. And it's entirely possible they're just getting their money back and nothing more. It's easier if it's a 1.5x return. It's an easier conversation.
It is, especially if it was done pretty recently. But to your point, I like how you said they're almost doing it as a favor.
Mm-hmm. And they will. Investors will be realistic about that this is kind of the game. And they have reputations too. And part of the reputation that investors need to have is that they will be supportive of founders and not make waves in transactions like this. They need to, they have to be concerned about how the founders will talk about them. They have their other investors who want to see them behaving well. But it's not nearly the same consequence of the transaction for these investors as it is for the founders who, could be walking away with tens of millions of dollars.
What usually happens in the trenches with one of these deals? Like, do some of the investors try to sweeten the existing pot for like current founders to go on? Or is it kind of like when you break up with a girl for the first time, then you get back together again, everybody knows that you're probably going to break up again? So
usually investors kind of get out of the way during the deal for the most part until they're asked. They don't try to have a deal renegotiated to be beneficial to them for the most part. I have seen deals where the founders and some of the employees get special incentives on at the end of the deal, like in terms of, retention bonuses and things that could be very, very large and sometimes outsize the size of the sale. And sometimes investors will get irked about that and push back. But for the most part, they stand kind of out of the way until they're asked to start signing things. And then they might quibble with, what kind of legal obligations they're taking on. In terms of after the sale is done, if there's no bad blood, I've seen these investors invest in the same founders again. Again, this is not making money on a deal is not the end of the world, nearly the end of the world for most investors.
Which, like, to people on the outside of this industry sounds crazy to them.
Yeah, it's just the game. I mean, you make 100x on one out of your 20 portfolio companies. Who really cares about the other 19?
I want to talk about starting the process. So we've honed in on some of the friction points in the messy middle. But to take a step back, let's say a CFO is getting serious. How should they think, David, about the banker versus the relationship route?
Again, I hate the "it depends" answer, but it does depend. It depends on what the case is for the sale and where the company's at, and kind of what you sort of want to accomplish as part of the process. So you have to start with one thing, which is if you're not big enough, you're not getting a banker.
And what's big? Like, what's the size of the bread box here?
If you're not going to be selling for at least, say, $40 million, $50 million, you're not getting a banker.
And why is that? Just the economics of the deal aren't big enough for the bank?
Yeah, exactly. The economics aren't big enough.
Okay.
And the numbers inch up over time. So, 10 years ago, I wouldn't, 20 million would probably be okay.
Yeah.
But okay, so let's say you're big enough that you get a banker, or you could get a banker.
Yes.
So then how much time do you have for a sale process? Because if you're getting a banker, the purpose of getting the banker usually is to run a real sales process, which takes time. It's to go out into the market and talk to different potential acquirers. And again, that takes time. So if you're in fire sale mode, you're going to run out of money, things like that, you probably aren't going to want to use a banker. It's also a louder process, right? I mean, you're going to have NDAs, but if you're having a banker going out there and talking to companies, it's likely to get known that you're on the market. While if you run the relationship route, it's much quieter. Mm-hmm. So those are the things I would, and then actually one other, you might have constituencies like investors who insist on a process that gets kind of the best deal out there, or you might have concerns like that sometimes the relationships that the company has to a seller are not arm's length relationships in one way or another. Like you want to sell, and the acquirer that you can reasonably reach out to is related to one of your investors or one of your founders or directors, whatever. In a situation like that, where there's questions about the arm's length nature of the potential transaction, having comparables, other potential buyers to bid helps defend the price with that particular acquirer. So in any situation where you want competing bids, going with a banker is going to be the better way to go.
That's really helpful. And you've said before that you're not anti-banker. You're just anti-bad banker. What makes a banker bad in your experience?
So there's two things that make a banker bad. There's the do-nothing bankers, which is, you'd be surprised how often that does happen. And it can happen in the sense that, yes, bankers get all or the vast majority of their fees by virtue of there being a transaction, but it doesn't mean they necessarily have to do anything for a transaction to happen. So I have definitely seen situations where bankers get signed on, they send out some emails and they just kind of sit around because they're not incentivized enough to do anything different. And that goes with the second part, the bad bankers, is the terms under which the banker gets signed on, which in themselves can disincentivize a banker from doing as much work as you would want them to do.
Let's get into that, because I want to talk about like actually looking at the LOI you get from the potential buyer, but the terms with the bank. How, and correct me if I'm wrong, that's probably also a good time to bring in your lawyer ahead of time to help with that too.
Yeah, you do not want to sign. And I have never seen an investment banker engagement letter that I have not wanted to mark up materially.
Because a lot of people will hire the attorney when it's time to sign an LOI, but they'll have already signed the engagement letter with the bank.
Yeah, they think they're not negotiable. They are negotiable. They are negotiable.
Yeah, PSA to everybody. They are negotiable.
Maybe you shouldn't sign it, or at least know what you're getting into. CFO should definitely know what they're getting into with this, because it can have huge consequences. And again, two ways. One is this incentivizing kind of way that I was talking about before. So what deals does the investment banker get a percentage on? They're going to get some percentage of something, and we'll get into that something second. But what deals? Is it deals that any deal the company does in a certain period of time? Is it ones where there's certain introductions or the like that are made, or some material help that the investment banker provides? If it's the former, if it's any deal while this engagement letter is in effect, if that triggers a success fee, then why does the banker have to do anything? And let me tell you, that is very commonly what they'll ask for. Are we carving out relationships that the company already has, or no? If we're not, and the company has some potential partners or vendors, customers that it might want to sell to, and the relationship's already there, do you really want the banker getting fees for that? I mean, maybe if they can play some role, but not necessarily. And then how you can terminate and what happens when you terminate, because most bankers are going to want some tail period post termination where they still get the success fee. That's okay. I've seen bankers ask for a 2-year tail period. I mean, that's insane. And then it's not just how long it is, but what does it apply to? Does it apply to any sale during that period of time? Does it apply to only a certain set of potential buyers? I've seen bankers do things where they just blanket send out emails to like 100 different companies, and then they put that on a list and they say, these are the ones that I'm entitled to success fee for. But that's absurd. I mean, anybody could send out some cold emails.
In your experience, is the pushback on a banker's engagement letter usually around the economics terms, like the percentage of fees? Or is that just math? Or is it usually a pushback around the tail period?
It's usually fairly easy to get tail periods, at least into a reasonable realm.
And what's reasonable in your opinion?
6 months.
Okay.
Maybe 9, maybe.
A year feels kind of stiff, right?
A year's stiff. Yeah.
18 months is crazy.
Anything over a year is crazy.
Okay. Have you ever heard an indefinite one?
No. I can't think of. No, I don't think anyone. I don't think so.
Okay.
That'd be. Yeah.
All right, David. So what's the second side about working with the bankers that you should consider?
So let's say the banker gets 2% of the transaction value. That's what it'll say. Something like 2% of the transaction value. What is the transaction value? And that is enormous. So it'll obviously include any cash at closing. It probably or almost certainly will include any equity of the buyer at closing. But what about, say, is the buyer paying off debt of the seller? That will likely, they'll ask for that to be included. And then you get into things like earnouts. Does the banker get a percentage of earnouts? They'll almost certainly ask for that and ask for it to be paid at closing in connection with the rest of it.
That was the one I was going to bring up. They want to get paid on the earnout amounts just to make the mound as big as possible, but they don't want to have to stick around for if it gets fulfilled.
Worse, you'll see bankers ask for a percentage of retention bonuses for employees that are going over, or any above market compensation.
No way. So if you get a raise, they'll ask for a percentage of that?
Yep. Mm-hmm. All the time. In fact, it was maybe 6 weeks ago that we closed a transaction with a banker where we got into a dispute with the banker because this was, thankfully, the company had come to us and we negotiated the engagement letter with the banker, and the banker forgot, and their normal engagement letter does say they get a percentage of above market compensation, and they were calculating their success fee differently than us. And they somehow, it was weird because they kind of just refused to go back to their engagement letter. They just were stuck on what their normal terms are. So it all got resolved once we, got onto a Zoom call. We're like reading the words to them. But yes, so not only do engagement letters say this, people sign engagement letters that say that.
That's crazy to me.
And as the CFO, some investor is pissed because they're looking at the waterfall right before closing and they see all this money going to the banker, and that's coming out of the investor's pockets too. And they want to know why. They're going to ask you. That's who they're going to ask.
That's such an astute point, because it's coming out of the investor's pocket too. If it's coming against the whole enterprise value plus everything else that was going to be distributed in the waterfall.
Mm-hmm.
Wow. All right. So let's wrap up the portion on the engagement letter, because what I'm excited to talk to you about is the LOIs, because they're like wet cement. They harden fast.
Yep.
So David, what should sellers absolutely push to include before signing?
Well, I always just say as much as possible, but there's a limit. It's not going to be 100 pages long. So obviously purchase price and how it's divided up between equity and cash, net working capital in as much detail as possible.
Yeah, sharpen your pencil on that one.
Yeah, you really have to, because it can mean millions of dollars. It's so easy to gloss over. It's usually a glossed over phrase, a normalized net working capital adjustment. And it literally can mean millions of dollars depending on all sorts of things, what's included in net working capital, what the net working capital target is, what methodologies are used to determine it. So as much as you can put in the term in the LOI on that, for sure. If you are having a mixed cash and equity deal, what is the value of the equity?
Mm-hmm.
How that's determined needs to be in the LOI. It's a negotiable term, whether it's a privately held buyer or a publicly traded buyer. You definitely want indemnification terms. If you're a private company seller, you're going to be indemnifying the buyer for all sorts of things that might happen post acquisition. Usually the main one is breaches of various reps and warranties.
David, stupid question. Can you explain, like I'm a 5-year-old, what indemnification means?
Yeah, sure. So in any purchase agreement, you, the selling company, are going to make certain reps and warranties about the company, saying, we don't infringe anyone's IP and we're not breaking laws and things like that. But dozens of pages of them.
It can be a really long list. Like I think
a huge list.
I think the transaction we did, it was like 70 pages.
Yep, that's not unusual. And so then, what does the buyer get if some of those reps and warranties end up being untrue? Well, it's called an indemnification obligation. So the sellers, or really the seller stockholders, agree to make the buyer whole for any losses they experience as a result of a rep or warranty being untrue. That usually comes in two different ways. One is, let's take the example of the infringing IP. So the buyer gets sued for IP infringement resulting from the use of seller's IP. Well, then the seller stockholders pay for the attorney's fees for the buyer to defend itself. They pay for whatever judgment there is. So those are kind of third-party claim indemnification. But then there's what one would call like direct claim indemnification, where, say, you're repping that there's no material bugs in your software. And it turns out there's some horrible bugs in it that the buyer has to fix. And it costs them $500,000 in man hours and the like to do it. Then you pay for that, like those kind of re-engineering costs. So the question then becomes, from an LOI standpoint, what are the extent of your indemnification obligations? Are there caps? There will always be some sort of caps. So this is the time to negotiate them. And are there different caps for different things? How long does the buyer have to go after the seller? You want it to be as short as possible. Maybe within a year of the acquisition, they can go after you, but not longer than that. If you leave it silent, it's not going to be in your favor later. And usually it'll be pretty silent in the buyer's initial drafts. And then if there's any kind of retentions or holdbacks of any sort, particularly for putting aside indemnity reasons, but for service providers, what the terms are, any kind of acceleration if you're terminated without cause. Honestly, I put the definition of cause into the LOI. I don't just say acceleration for termination without cause. I say what cause means, because you'll get a better answer at that point than you will if you wait till after the LOI.
Anything else that sellers should absolutely push to include?
Any terms related to an earnout. If there's going to be an earnout, any protections that you as a seller have with respect to an earnout should be in that document.
And you should clearly define the metrics related to that earnout.
Yeah. So you want the earnout spelled in as much detail as you possibly can.
And what I've noticed is that bankers want the LOI signed really fast, and then the lawyers want to fully lard it. Yeah. And CFOs, I mean, they get stuck kind of in the middle, right? Where, like, how do you help them decide what's worth pushing for?
So the incentives on the part of the lawyers and the bankers are completely different. So at all times, this is not just an LOI thing. This is going to be at all times in the process. The banker is going to want this deal to close as quickly as possible. And the lawyers don't really have any incentive for that to happen. And there's pejorative ways of looking at that, and there are not so pejorative ways of looking at that. You know, the bankers only get paid if the deal closes. The lawyers get usually paid by the hour. And if it stretches out longer, it's better for them. So that's the pejorative way. But there's a less pejorative way. I mean, bankers, you know, they're there. You want a banker who's there to get the deal done.
Yeah.
And you want a lawyer who's there who can perceive risk and try to protect you from it. There's not really that much for the CFO to do in terms of the banker. You hear the banker out. Maybe it's my own bias. I would push on the lawyer in a sense if I'm the CFO. And let's put aside, you need to get them to explain risks. Any risks where they're saying, we need to delay this, negotiate this more. Try to get them to not quantify the risk in dollars. They're going to have a hard time doing that. But like, realistically, what are the chances of this happening? How many times have you seen XYZ happen?
That's a great question. How many times have you seen it?
You want to get the lawyers into the real world. I don't blame them for the fact, you know, maybe I'm because I'm a lawyer. I don't blame them for the fact that they can be a bit theoretical about things, because everything is about hypotheticals. But as the CFO, you need to make the risk decisions. And so you need to get them into the real world, and you kind of level set them.
What are some other inherent conflicts that lawyers and bankers will have?
Essentially, bankers want to do anything that's quick. So the problem there is it might mean not disclosing certain things, or not necessarily telling all the internal. It's just kind of whatever gets the deal done as quickly as possible. And that shows itself in all sorts of different ways. It does in terms of what you negotiate and what you don't negotiate, what I's you dot and T's you cross, while the lawyers are going to want to do all of those things. It doesn't show itself in just in one way. But that is the inherent conflict. It's one source of conflict.
And if you're a CFO or a CEO who wants to politely say, thanks for the advice, banker, but I'm going with my lawyer on this one, what's the right way to broach that or communicate that?
Bankers are used to kind of aggressive. I mean, they're like lawyers in that sense. Don't worry about it. They're used to it. And so are the lawyers. You just gotta, that's not really worth your worrying about. Be polite. I mean, be a nice person, but almost certainly going to happen. Like, I rarely see deals on any side of them where there is not some time where bankers and lawyers are giving very different advice.
David, you'd mentioned the importance of net working capital targets in the LOI. Give it to us straight. What's the worst case scenario if that's vague?
The worst case scenario is where you end up post LOI without much leverage and all the stars are aligned against you. So for example, you're a company that has not been using GAAP financials. You have your own bespoke cash way
I've seen it.
of calculating things. you have there's seasonality to your assets and liabilities in various ways. And it all kind of times itself out that at the time where you're actually negotiating the definitive agreements, you're in a bad period for your capital needs versus what your assets are. And if you were using GAAP financials, which the buyer is going to insist on, and they'll say, I don't understand what on earth you've been doing, but how can we possibly evaluate net working capital based on this random set of methodologies for financials you've been doing? And then as a result of that, either the definition of what net working capital is, or it's hard to basically negotiate at that point. There's no reasonable way to negotiate your way of calculating net working capital. That does happen. It's hard. It's hard on particularly an earlier stage startup where it's hard to defend what you've been doing.
And I think what I'm poking at here is that if you get it wrong, it can be a real life deduction essentially to
millions of dollars. Millions. I'm telling you right now, it can be millions of dollars. You want everything about net working capital in the LOI. There's no reason it can't be there. You want what the target is. You want how it's calculated. People tend to adhere to the LOI even if it has somewhat absurd consequences.
Like the easiest real world example for people is if like you own like a Halloween pop-up costume store and like you need that inventory around the season when Halloween happens. And so you go to sell it and you liquidate all the costumes beforehand to make an extra buck, and you give them basically like a car without a full tank of gas in it to run the company.
Right.
And people are like, oh, well, I run a tech company. Like I don't sell anything in the real world. But like I've found that in particular annual contracts, especially multi-year contracts, that can be a big component to consider.
It can't be how does deferred revenue, you get paid up front. How does deferred revenue appear in net working capital calculations, for example? That's, and tech companies have seasonal aspects to them. I have clients who are in like application like applying for programs of various sorts.
Oh, okay. Like a college application or something.
Yeah. Seasonal. Tech can be seasonal.
David, how can a company de-risk itself in the eyes of an acquirer before it even enters the process? Any tips there?
What a buyer wants is predictability around things. And that could be financials, that legal, reputational, everything, predictability. So if as much as can be ferreted out in advance so that you can either eliminate the risk before an acquirer ever comes into the space, or you can at least have a narrative for things and surprises don't come up, the better. So in that respect, you make sure the cap tables are cleaned up in advance, that any IP issues are cleaned up in advance, that your compliance regime is in place. So how you're handling classifying employees. I mean, there's, the CFO, lawyers, HR, there are ways to make sure that legal risks and financial risks are identified as early as possible. Have the company in a place where when someone starts doing diligence, it's easy to do, easy, organized. You look professional. Looking professional and buttoned up provides credibility, and you need credibility in the process of being acquired. So there's a lot you can do in advance, both to ferret out risks, but also to just create a situation where a buyer is going to believe you as things pop up, because things will pop up. And the reality is, unless you are a very late stage company, going through acquisition diligence is going to bring up something that you haven't found, because you're going to have so many people poring over every aspect of your business.
What often pops up, like what I've heard nightmare stories about, is like not actually owning your IP. Anything else?
I mean, that does pop up in all sorts of different ways. Non-compliance with various laws pops up.
Oh, state tax. That one pops up all the time.
Oh, sales, yeah,
sales
taxes, sales taxes. That's a common one. Yeah, privacy issues pop up quite frequently. Now AI issues pop up all the time.
What are you seeing there?
Let's say use of generative AI, how employees at your company are using various tools out there. Does the company have a policy that's enforced to make sure that, just a simple example, people aren't putting in prompts into some, non-enterprise version of ChatGPT with company trade secrets in it?
Yeah.
A lot of companies don't have policies in place at all for these things.
No, it's Wild West.
It's Wild West, but an acquirer is going to be asking these questions.
Back to what you were saying before about credibility. How can an acquirer risk aversion derail a deal late in the game? Like, what's the CFO's job in managing that perception? Because I do believe that perception is everything. Like, you do want to look buttoned up. Like, you want to remain credible throughout the process.
Right. And so the CFO should, just like at the pre-acquisition process, the CFO should work with the various compliance type people, whether it be lawyers or otherwise, to ferret out risks. That should also happen during the process. So to the extent feasible, you want to have this, you as a CFO want to work with your internal and outside counsel and the like to look at the diligence materials as well and think about the various reps and warranties before you start disclosing things to the acquirer so that you can ferret out those problems, create a narrative, all those sorts of things during the process. And then you want to be solutions oriented as part of the process. So you create a narrative and then explain how it is that we're going to solve the problem, mitigate the risk, model out how it's not a big deal financially. I mean, because when you're an acquirer, let's take the other side. You run into a risk in a deal. There's really three ways to go mainly.
What are they?
One is you walk off.
Yeah.
Okay.
Pencils down.
10 pencils down. Number two is you renegotiate the purchase price.
Retrade.
Yeah. And number three is you deal with it with the indemnification that we're talking about. Okay, there might be some liability here, but the sellers will eat it if it comes up as part of indemnification. The reality is you as the CFO want to get us into category 3. I mean, if you don't want to do the deal, you don't want to do the deal, but chances are you don't want the buyer to walk off. You don't want to renegotiate the terms of the deal because that's taking a hypothetical risk in the future and making you eat the cost of it right now. You want to keep it in hypothetical land and we'll deal with indemnification. And then maybe you negotiate how much of that indemnification you really have to eat.
I like how you say keep it in hypothetical land because you never want to take the net present value of a future risk and bring it to today and get dinged for it.
No one's discounting it. I'll tell you that right now. No one will ever discount it. If they think it's a $10 million hit, in 3 years, they're going to want that $10 million now.
A potential $10 million
A potential hit. $10 million. Yeah, no one's saying, well, the expected possibly, no one's doing that. If they think it's a $10 million hit, potentially, they're going to want $10 million off the purchase price. If you can get it $10 million potential indemnification in the future, that's great.
David, let's touch on the human element in all of this because you've been in a lot of meetings probably where emotions get high. What's something you wish more founders understood emotionally about selling? The
thing is that founders think about it at first in terms of dollar signs and don't necessarily realize, and this is particularly for founders, this is not for non-founder executives, which is kind of different. The company is their baby and they may not realize how they're going to feel about giving that up. And that can really matter in dollars and cents in one particular way, which is you as a founder might think, oh, I'll stay with the buyer for 3 years post closing and have my consideration vest over that period. But once your baby is part of another company and you're kind of a cog in the wheel of that, you might not be able to emotionally handle that anymore. And so many founders I see can't stay. They just cannot stay, either because they're so used to being their own boss or they can't watch what's happening to their baby post closing. So think about that emotional element to this whole thing. because you don't want to have an unrealistic view of how you're going to be able to handle what happens after you sell this company.
If you had to ballpark it, what percentage of founders stick around for the full term of their earnout?
I'd say about 30% voluntarily leave, and I'm trying to think what percentage. See, I would say 40% are kicked out, but
I like how you broke it into that too, because there's a large contingency who are kicked out.
yeah, I'm afraid that I'm overestimating that, because the ones that get kicked out are, they're more likely to tell me than, they're more likely to come back to me and be like, hey, I got kicked out. And then we have to deal with that. And was there something breached or something like that?
But either way, those numbers add up to more than 50%. Don't make it.
Yeah. I mean, yes, I don't find that most founders stay with the company for the entire earnout period.
And let's say you're a hired gun. Let's say you're a private equity CFO, CMO. It's Tour of duty. Anything else that you should emotionally know about this process?
On that side?
Yeah, if you're selling, or anything that you should sharpen your own pencil on before it all goes down.
You've been working very hard for a long time on something, and it's going to be torn apart. I don't mean torn apart post-closing in the way that a private equity buyer is going to tear things apart to pieces, but every hole you've talked earlier about founder visionaries. You have this 10,000 foot view of what your company's doing and done and all the great things. There are going to be holes poked in every single thing. Everyone's going to focus on every problem with every single thing you've done.
It's so true.
Maybe when they're coming up with a price, there's all this excitement. But other than that, you're going to have to get used to having every problem under a microscope. The other thing is, and this is actually no different than a VC financing, but it's something to keep in mind as a founder, that chances are whoever you're negotiating with on the other side does this all the time and you don't.
Such a good point.
You need to think about all the rules of negotiation matter. They're not, the folks on the other side are not your friends. They might act like it sometimes. They're not. Don't let your ego get the best of you. They might try to fluff you up and things like that at certain times. Don't let that happen. You have to negotiate like a real negotiator and lean on your team to help you do that.
David, what you said about everything being criticized that you've done or that you've built is just so true. And it's this juxtaposition where it's I thought that you thought we were amazing. That's why you're paying all this money for us. You gave us all these compliments and you're buying us. And then after that, it quickly turns to everything that's broken. The way that you calculate this is wrong. You actually don't have as much pipeline as you said. It's only the bad things about you after.
Right. But that goes back to the prep for the acquisition, right? Though there are going to be problems, but you can minimize the number that are found. If the pipeline isn't as good as it sounded, is that because they're being overly picky, or is that because your projections were really kind of BS?
It goes both ways. I do want to point out, though, that there is this sentiment change where it's oh, I thought we were all friends because you're buying us. And it's no, we're just now going to give you the negatives.
Yeah. And don't get rattled by that. That's just the way the world is. And that some of it's an act and some of it isn't. It doesn't change, believe in the value prop that you're adding.
David, maybe gearing towards a close here. Yeah. What's your read on the current state of how companies are sold today and kind of how there's a set of market terms, it feels like? Yeah.
I mean, the good thing is there's a lot of M&A activity still going on. I do think that, and this is the same with VC financings and acquisitions, is that there are a relatively small number of powerful players that kind of set market standards for things that don't necessarily make very much sense. I kind of wish that there was more flexibility and more rational negotiation over terms. The reality is, over time, for the most part, for sellers, terms have gotten worse. There's more liabilities that the sellers are on the hook for longer periods of time. It gets harder to negotiate things like protections for earnouts and the like. The important thing is to know what you're getting into. Listen to your advisors when they tell you kind of what the risks are. Don't don't fall into the trap of, getting into, becoming paralyzed by it, but understand realistically what the real potential things that are going to happen, so you don't have dollar signs. Take it with an earnout being example. If a buyer is not willing to give clear metrics and give you enough control over things in terms of how you can operate post closing so that you can achieve earnouts, just assume you're not going to get them and go into the deal. Like, are you willing to go into a deal where you don't get that money? You just have to be realistic about it.
David, why do you think it's shifted to be done a certain way? Is it like a power dynamic of just who does the most deals out there? Or is it because people are stuck in the ways of like, well, that's how we did the last one?
Yes and yes. And this is somewhat industry specific. In the tech world, there are dominant buyers. There are dominant law firms that represent the dominant buyers. And oftentimes they represent the sellers too, which makes it even worse.
Yeah, that's a whole nother bag of burritos there.
Interestingly, though, I was a year ago at a conference where it was a American Bar Association conference, where the American Bar Association had a committee that was trying to put together kind of a model purchase agreement for mid-market sale of a company. And the terms were so buyer friendly, and everyone kind of acknowledged it. And I did ask the question, I'm like, why? Like, what seller is going to ever want to use this? And they said, well, the only way we can get this adopted is if buyers adopt it. And given kind of the narrow market, the narrow places where this, would get used, this is kind of where buyers think they're able to be.
Because the term that you used with me was cookie cutter.
There is that aspect to it for sure. And tech companies, particularly interesting, they get used to it because VC financings are very cookie cutter. But there are, you can look out there in the acquisition world, and there are studies done and published on standard terms and what's, percentages are of this term versus that term. And it gets more homogenous over time. And to me, it's inefficient in a sense, in that the terms don't match the deal and the profile of the deal and the risks of the deal. And sellers might not be as willing to do a deal because of the terms are not reasonable for the particular situation, or deals get slowed down because of that. There'll be negotiation over a term, and the buyer can't really justify what they're asking for other than the fact that it's market. And then the market, and then that just becomes an end of itself.
Yeah, when you hear the term "it's market," it's like, oh, so you're just using like a catch-all here to get me.
Using a catch-all, exactly. Yeah.
David, this has been a blast. Thanks for all the insights. If people are looking for some help and something related to this, where can they find you?
You can find me. Our firm is Grellas Shah. We're at www.grellas.com, GRELLAS, and happy to talk to anybody. I like talking to people, so.
I had a lot of fun talking to you. Thanks, David.
Same here.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.